Hello, going to talk today about employer benefits. So this would be once you take a job, hopefully some of you will be graduating in the next 6 months, year and a half. You're going to take a job and hopefully your employer will provide a different recipe for benefits. You get to pick and choose what you want. Some of them will be standard, but you'll get some kind of a benefit from different employers. That's what we're going to cover today. The most common things that are provided by your employer would be life insurance, health insurance, and then there's a few other group type benefits. I just wanted you guys to be familiar with these, especially as you're negotiating a job. It's really important to look at benefits. Maybe you don't care about it and you want to get the most pay, but benefits actually are cash in your pocket or that you have at your disposal that you don't realize. Maybe you don't get them in your paycheck, but if you didn't have good health care or you didn't have other good benefits provided to you, you actually have to add those together. So maybe you get paid a little less in one job compared to another, but the other job doesn't give you all the benefits that you would get with a lower paying job. So you have to kind of put that whole package together before you can make a decision. I'm going to share my slide deck with you. Give me a moment. Okay, employer benefits. Like I said, this would be for you go to work for someone. You are going to be able to ask for different benefits, or they're going to provide different benefits. So what do those mean to you as an employee? These are provided by your employer. Sometimes they're paid for by your employer. Sometimes you pay a percentage of them, or you get a discount by being an employee. These are things other than your wages, so they're not your day-to-day paycheck. You have to add them in, and those add to your overall economic security. So it's good to have those things, especially if they're lower cost and free to you. Some of them, like I said, are paid by the employer. Some are partially paid. What do those include? A lot of times it's group life, medical, and dental insurance. Those are really good to have. Another benefit you don't think of, it's not insurance related, would be having paid holidays and vacations and medical leave. So if you're sick, it's good to have sick leave. Right now, COVID, at my employer, we're very blessed to have a lot of sick leave. Most employers don't provide this, but you can continue to save up your sick leave, and you can save up to 6 months worth of sick leave. So let's say I have a major medical condition, have to be off for 6 months, have a major back surgery or something else happen to me, that guarantees I'm going to be paid for those 6 months. It's really good if you're a young parent and you need to take off to have a child, you can use some of that leave there, all good things. Educational assistance, that's another really important one. You guys probably don't care, you're done with school, but I know when I started working at City Utilities, my previous employer did not provide education assistance, and I moved to CU because at the time, no longer true, they paid for my entire MBA, my books, my tuition, everything. So that was a really nice perk that I would not have gotten at my previous employer. Sometimes you get employee discounts by just being a member of a large organization. They also contribute towards your Social Security and Medicare, which we talked about in the past. They have to pay a certain percentage of your wages to the government to cover those expenses for you in the future. Group health or group insurance overall, what does it mean? It means that you don't have to worry about individually qualifying. There's one master contract. You don't have to prove that you're healthy. You don't have to prove that you're worthy of it. Being an employee automatically qualifies you to be a member of the master contract. And so, again, you don't have to qualify. You just have to pay the fees. Usually it costs less than if you had to go out and buy it by yourself. In the last chapter 15, I talked about buying your own health insurance, pretty expensive. But if you're a member of a group health insurance plan, it's usually significantly cheaper. So what is that group insurance based on? So they're trying to say that the group can't be formed solely for the purpose of having health insurance. So what that means is you're a member of the group because you're an employee that does some specific task or work for the company. It's not that you created this group insurance plan just because you and some of your friends decided to go together and say, we are so-and-so group Inc. and we want to create one. There has to be people coming in and out of plans. So that makes sense, especially from healthcare. You don't want everybody who's older having to pay for it because the costs are going to go up and they don't want to have to keep increasing their fees. But if you have younger employees coming in and some of them retiring, it kind of keeps the flow going. It doesn't kind of stagnate. Your benefits would automatically be determined by a formula. They don't differentiate. Like if you're more healthy, if you're a smoker, you get different rates than someone who's non-smoker. Typically that doesn't happen. Now I do know of some employers that do that. There is a minimum amount of people that have to participate in order for it to work. And usually the individual members don't pay the entire cost. That's where your company helps supplement. And then who's eligible? Again, most of the time you have to be a full-time employee. You have to be an employee for a certain amount of time to meet that eligibility requirement, and you have to be actively working when your coverage begins. So what's the most common type of group insurance? I would say is life insurance. Most companies do have a group life insurance policy. It's very, very cheap. You can buy probably 1-2 extra times your salary. A lot of employers will say we'll pay one time your annual salary as a life insurance base. If you want to add another layer, twice your salary or 3 times, you can add that for a really, really cheap cost. You don't have to prove, like I said, your health to get involved or to be qualified. And then when you leave the company, you're automatically out, so you'd have to go find some other option. It's basically term insurance for the most part. It's rare that it wouldn't be term. That's how the ones I've ever seen. So you guys remember from last chapters, term means that you're getting a flat fixed amount. Rates could go up over time. Now your employer usually guarantees they're going to pay for one layer. So they pick up the additional costs as you get older. But this happened to me. Once I hit a certain age, my cost went up and I decided I don't want to keep those layers anymore. I can get it cheaper somewhere else. So I just dropped those because those rates keep going up over time for the ones out of my pocket. So this is a really good, if you're on the other side of this equation and you're trying to sell life insurance, you're an agent, it's great to go to an employer because you sell a lot of policies all at once and you don't have to go door to door and individual by individual to do that. And they can actually take it right out of your payroll check. You won't even miss it. Group medical is another very, very important thing. You guys take a job anywhere, you want to make sure you have good health insurance. It's only going to go up, and at some point in the future, you will not be able to be qualified on your parents' plan. And so it'll be a big portion of your check, believe it or not. There's a lot of different plans out there, but most of them are covering your major medical expenses. So I'm going to cover a few of those. They can both be sold individually, like we talked about in the last chapter, or they could be group medical with your employer. So the first one is Blue Cross Blue Shield. I'm sure some of you have heard that term before. I used to think it was just like a company, but what Blue Cross Blue Shield plan, it's a plan type. And basically it means it covers certain types of expenses. The Blue Cross, I think of it in this way. When you go to the hospital, there's usually a cross over the hospital. If you go to Mercy, they have a cross as you come in. Blue Cross plan covers your hospital expenses. Blue Shield, on the other hand, covers all your physicians and surgeons fees, any doctor's expenses, labs. So the Blue Cross part covers one and Blue Shield costs the other. A lot of plans include both of them. It's not one or the other, but you have different parts of your plan and they are called different things. Managed care organizations, these are very common. Generally, they're set up as a not-for-profit and they offer managed care to employers. Well, what does managed care mean? It offers a benefit. They try to make it cost effective. They give you discounts for being part of that, and they really try to control costs. A lot of employers, including my employer, is self-insured. So rather than going to an insurance company, we all are grouped together. There's 1,000 employees. We all pay our premiums. If I don't have any medical expenses, I'm still going to pay the same amount every month as my coworker who may be have a lot of health issues. They could have heart disease or be diabetic. And if they have a bad year, meaning they had a lot of medical expenses or hospitalizations, that's going to come out of the big pool. We're basically pooling our resources together. We all contribute. The unfortunate part of being self-insured is when you have a really bad year, you don't have a backstop sometimes. And so we've had some years where catastrophically sick individuals, meaning that's a major medical expenses, it caused the entire plan to increase in cost for everyone. But you can buy stop loss insurance from a third party, which basically says once you exceed a certain amount of expenditures, maybe you want to set it at $10 million, then from that point on, the insurance company would pick it up. It's kind of like reinsurance where they back you on the high end. So under a traditional indemnity plan, we're talking about years ago, this is what everybody had. You could go to any doctor you wanted. There was no such thing as a network. You just walked in, you picked a doctor, you went and got something done, you paid a fee for what you got. That's called traditional indemnity plans. Very costly. There was no containment of costs, there were no discounts, there was no structure around it to minimize costs. And those plans, as you're going to see in a moment, decline significantly over time. A managed care, really, a plan is just a generic name for any plan that puts together a package or covered services to its members in a cost-effective way. Everybody pays a certain fee. The doctors are limited, the hospitals are limited in how much they can get. So let's say they try to charge you more than what your plan is willing to accept and pay, they have to take the discount. So they have to adjust their bill, which is good. You have the buyers in bulk, so you get the negotiating power by buying in bulk. There's a lot of cost control. They really try to do a utilization review, so how effective they are at curing people and how they use tests. They try to increase the quality of care. They monitor and do surveys of the doctors. There's a lot of emphasis on preventative care and having healthy lifestyles. They're trying to be proactive rather than reactive. A lot of you have heard the term HMO, which is basically a type of managed care plan. These type of plans are restrictive in that you can't pick you can pick your doctor, but you're very limited. And they actually are paying services on a prepaid, and your cost sharing is imposed in those plans. Heavy emphasis on controlling costs. You have to pick that primary care physician. That's why a lot of people don't like this. Let's say you pick your primary care physician. Anytime you have any ailment, it could be an inner ear infection, could be your knee's out of place, you need an orthopedic specialist, maybe you have stomach issues. You have to go to your gatekeeper or primary care physician. They have to then refer you to a specialist. You can't just pick a specialist and go there. A lot of people don't like these kind of plans, and they actually fix the amount that's actually paid for each type of service. The better plan, a little bit better managed care, would be a PPO. It's a preferred provider organization. The best way I can explain that for Springfield would be you pick a Cox network or you pick a Mercy network. You get to stay within that network, and those are all considered in network and get the cheaper rate. You don't have to stay with one gatekeeper or physician. You can actually, choose to go to a different heart specialist versus a different orthopedic surgeon if you need to. You don't have to get permission to see a specialist. Still has lower fees, but a little bit more. It's a little less restrictive. And then there's a point of service plan. It's typically structured like an HMO, but members can go outside of the network. So you wouldn't have to pick Mercy and Cox. That's even more freedom. Again, in order to get that freedom, it's going to cost you a little bit more. So what are the key features of having a group medical expense insurance plan? Well, the one thing is it's typically cheaper. You get an overall package of benefits. You have a calendar year deductible, no different than an individual plan. So you have to spend a certain amount out of your own pocket first. You're going to have co-insurance. So even if you reach that deductible, a certain percent will always be paid for by you. You always have to pay a co-payment when you go to the doctor, whether it be $20, $30. If you go to get a prescription, it might be $10, but it's your co-pay. You have a maximum amount you have to pay out of pocket for the year. If you have a really bad year and you pay a lot, it's going to cut off the bleeding and basically say from that point on, the insurance company will pick all of it up. How did the Affordable Care Act overlap? Well, the good thing for all of you, and I mentioned this earlier, it's going to impact all of you, it's good to know, is that prior to the Affordable Care Act, students, young adults, once they graduated from college, would no longer be eligible to be on their parents' health care plan. And as I mentioned, it's a very, very expensive, several $100s a month to pay for health care, even for yourself, let alone a family. So under the new rule, they have to let you stay on your family's healthcare plan until the age of 26. So you graduate from college at 22 or 23, you don't have to jump on your own plan and pay out of pocket until you're 26. Especially if you have younger siblings, there's no discount by taking you off the plan. So do not be tricked into saying, well, I've got a full-time job and they offer it and it's cheap, I might as well buy it because I have to. You do not have to buy healthcare until the age of 26, as long as you are on your family's plan. And then they got rid of the maximum out of pocket in your life. It used to be like if you ever spent more than $1 million in your lifetime on healthcare, you were capped. They'll never pay another dollar. That no longer is true. It's very rare that someone would spend $1 million in their lifetime on medical, but not impossible. You don't have to worry about pre-existing conditions. And then a lot of the smaller employers got tax credits. But as I mentioned earlier, that really didn't encourage a lot of them because it still is very expensive. There was a grandfathered plan, so you didn't have to immediately go on 2014 on the day it was implemented, automatically create this. You got a little bit of flexibility. They did have some uniform coverage. They did provide flexible spending accounts, which we'll cover more in a minute. So what is a consumer-directed health plan? That means you yourself get to direct your healthcare plan. It's a generic term. It's like a health savings account. And I know this is not going to make a ton of sense if you've never dealt with it. But let's say every year you know what you're going to spend money on. I myself may say I'm going to spend $1,000 a year for health visits and prescriptions for my children and myself. I set aside those monies pre-tax. I get to put them in the bank and starting January 1, and if I need to draw it all out on January 2nd, I can. I pay in each paycheck until it's paid back at the end of the year. So basically, it's like a payment plan to set aside, and I get the tax benefit of not having to pay tax on that part of my income. Some people, especially if you're younger, and this has actually been debated internally, would prefer to have a high deductible plan. Instead of having that really, you guys remember how deductibles work. The lower the deductible, the higher your insurance premium. So let's say you're young, you're 23 years old, you're healthy, $500 deductible is important to you. You want much cheaper health insurance. So you'll say, well, make my deductible $1,000 or $2,000 or $3,000 because I'm most likely not going to have an event that's going to be that significant. So that cheapens your insurance, but again, you have to be in good health to want that. What are the recent developments in these type of plans? Like I said, no matter what we're looking at, health insurance premiums continue to go up and up. So we're always looking for ways to cut costs. A lot of times employers that used to pay more of your premiums are shifting those costs to their employees, making them pay more of it. There's still a lot of PPOs out there. That's the one that gives you the ability to pick your employer, your doctor, and go to specialists, but you have to stay within the network. Those are really common. A lot of areas, especially with young, new millennials and Z generation employees coming in, they want those high deductible plans. So those are becoming more popular. And then they're trying to use a lot of health risk assessments. We call those wellness plans, where if you do a certain healthy activity, you're going to get a discount or you're going to get some kind of kickback or benefit for doing that. And actually, my employer actually created an on-site health clinic that's actually free. So instead of having to go to the doctor for like a physical, or maybe I just have allergies right now, instead of paying a large premium to go to the doctor, I can actually go to the free clinic, which is at my work. I don't have to leave work, but for maybe 10 minutes to go over to the clinic. It's in my same building. I get to go. No different than I think than most of the colleges have healthcare clinics for their students. That allows you to be able to go there and get those small things taken care of, not big events. Like if you have a major health issue, you got to go to your doctor, but those help. This is just to show you. So 1988 to 2011, you're talking about a couple decades. You'll notice that the conventional plan, remember what a conventional plan is. That means you can go anywhere you want. There's no cost savings. Nobody's coordinating the planning. 73% of plans out there were conventional, meaning you could go anywhere you wanted, anytime you wanted, and you had to pay the fee. Those now are very, very small, less than 1% of, in 2011, actually had those plans. So it basically went away. Nobody uses them anymore because they're too expensive. You'll see a significant growth in this gray area that represents the PPO. Those went from 11% way back when. They went up and they've come down a little bit, but they're still in the over the 50% mark. Another area that kind of increased in growth and then went back down was the HMOs, which is where you actually, and this, I had this at my organization for a while, where you had to pick that primary care physician who was your gatekeeper. We don't do that anymore, but that was at one time very popular. And the one that's been going up more recently, since like 2006, there's some other new types of plans that are coming into place, just more creative ways to having that high deductible health plan that people want. Again, we got rid of the pre-existing conditions. We talked about coordination of your benefits. So when you have a group health plan, they take care of coordinating all of your payments and taking care of all your dependent children. So that was really helpful to have it all under one plan. It all is covered under your payroll deductions. Group dental is a really great benefit, although I didn't have it for many, many years. I've only had it for like 10 years, and I've been at my company 27 years. It's not completely the best coverage, but I also priced it individually, and it's pretty expensive. There's really a max amount you can spend every year, but it helps like for your cleanings and some, maybe it pays half of what your filling might be. So that helps a little bit. And what I found is, even if you break even, it's nice to know that you have that backstop to cover in some bigger expenses. You don't always use it. Group disability. So we've talked about disability in regards to I get hurt on the job, or you talked about federal disability. This is not like the federal disability program that was put into place to make sure people are protected that don't have income when they're disabled. This would be either your employer or you decide to have your own disability coverage, and a lot of employers provide that, especially group ones for disability. So they pay a weekly or monthly amount if you get disabled for a period of time. It does not have to be work related. It can be non-occupational, like you get hurt at home. And you have to be totally disabled to qualify, but it helps give you at least a certain percentage of your income for a period of time. If you get a long-term disability plan, there's both a long-term and a short-term. The benefit can be ranges from 1 to 65 years. It's going to cover you for an extended period of time, especially if you get hurt when you're really young and you can't perform a lot of your duties. Long-term plans cover both occupational and non-occupational disability. So there's kind of a fine line, sometimes your work comp picks up, but then if you have a backstop with a group disability plan, it can help pick up after a period of time for the long haul. If you are receiving Social Security or other disability benefits, then you wouldn't get as much. They don't want to keep you on both plans. I think I deleted the short-term plan, but essentially that one's just a little bit more restrictive. What is a cafeteria plan? Maybe you've heard that. If you've ever been to a cafeteria, and it's not like a thing of the past, especially now with COVID, but you go in there and you kind of pick, okay, I want this potato and I want to get that piece of meat, and then I'm going to get I'm going to get Jell-O or some kind of potato salad. You get to pick what you want. That's what a cafeteria plan is. Basically, you get to pick and choose which benefits you want. There's usually a lot of different benefits your employers provide. Not all of them are required. So I mentioned dental, and we have vision coverage. You don't have to participate in those. Those are options. And if you want to spend money on that, they can help supplement them, or you pay a certain amount out of pocket. So you get to pick and choose what you want. Not everybody wants to go back and get educational assistance. That's a choice, but it's available to you if you choose. So in many plans, the employer gives each employee a certain number of dollars to spend. My company, it's an additional $4,800 a year. Every year I get $4,800. I can choose to spend it on dental insurance or health insurance, premiums for my family, whatever I choose. But it helps supplement the cost of the different benefits. And a lot of times you can take those out pre-tax. So you have a little bit of tax incentive to do that. And then another thing that's real common, and you guys need to understand this concept, it's especially when you're young, you don't really understand it. It took me a while to understand it. What's a flexible spending account? So I sort of explained it earlier, where you take the money out pre-tax. If I say I want to take out $1,000 this year pre-tax to my flexible spending account, because I know I'm going to spend that, I get to have it deducted out of my paycheck for 52 weeks, a small, that smaller percent. So it's like I'm making a small payment on a $1,000 loan. But if I need that money on January 2nd, I get all of it right then, and I continue to pay that small premium every week. Why do that? Well, because you get, first of all, you get tax-free and you don't have to pay all of it out of your pocket, all at once out of your own pocket. You have to be really careful not to over guess what you need. You want to make sure, because you have to spend it within a certain amount of time. That's all I have, and I'll talk to you soon on, we're going to cover a couple commercial policies, property and liability policies at a high level. Talk to you soon.